Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, macro developments, sector trends, and investment themes shaping the day. Today is Wednesday, May 20, 2026. We're Elena and Marcus.
To properly frame today's discussion, we need to begin with the three most critical themes emerging from our latest run.
Right. These are the essential takeaways for anyone managing macro-focused exposure right now.
Correct. The contradictions in the data are extreme, so let's establish that baseline. Theme 1 from this week's data deck is the macro divergence.
The current equity melt-up is effectively masking severe underlying rate pressures across the curve.
Indeed. The 30-year Treasury yield has broken the 5% threshold.
Which is its highest level since 2007.
Right, and concurrently, the 10-year yield has hit 4.67%.
Understood. And that leads to theme 2, which centers on the geopolitical energy shock and the resulting options flow.
We track WTI and Brent crude plummeting between 4 and 6%, following the news that U.S.-Iran negotiations are entering their final stages.
And proprietary trackers confirm this supply shift. They show Strait of Hormuz oil exports ticking up to 6.6 million barrels per day.
Correct. Which brings us to theme 3, the institutional hedging disconnect.
Despite incredibly strong headline earnings, particularly in the mega-cap tech sector, internal prime brokerage data reveals a highly defensive posture among sophisticated participants.
Institutional short exposure to macro products, specifically index and ETFs, has reached a 10-year high.
So if we synthesize those three themes, we arrive at the primary friction driving this market.
Right. Equities are aggressively pricing in a seamless AI-driven soft landing. Simultaneously, the bond market is pricing in structural embedded inflation and a higher terminal cost of capital.
Mathematically, these two realities cannot coexist indefinitely.
They cannot.
Moving to the desk data, let's unpack the equity side of that divergence first. The metrics on current valuations illustrate this tension perfectly.
Yes, our desk data shows the S&P 500 equity risk premium has compressed to a post-global financial crisis low of 2.2%.
Let's put that 2.2% into context for the listener. The equity risk premium is essentially the extra return you demand for taking on the volatility of the stock market compared to just sitting in a risk-free government bond.
Correct. With a 10-year yield at 4.67%, an ERP of 2.2% means you're taking on historical equity risk for a remarkably thin sliver of excess reward.
Why is the market willing to accept such meager compensation?
The catalyst for this sustained equity resilience remains hyper-concentrated in the technology sector, specifically around the AI infrastructure build-out. Overnight data highlights this concentration perfectly.
The major chip leader reported a highly robust print.
Indeed, delivering revenue of $81.6 billion, which comfortably beat analyst consensus.
And their Q2 guidance was equally aggressive at $91 billion, supplemented by an $80 billion buyback authorization.
When you see top-line growth at that scale, momentum algorithms and retail capital are naturally going to compress the risk premium. I mean, they're pricing in infinite growth.
But let's look at the internal notes on that exact earnings print, because the mechanics of what they are building are changing.
Right. We're tracking a structural shift away from standard generative AI toward agentic AI.
We aren't just talking about language models generating text anymore. We are talking about autonomous systems executing sequential actions.
And mechanically, to run agentic AI, the hardware requirement shifts dramatically. Our models point to a 4-to-1 CPU to GPU deployment ratio for these new data centers.
That ratio is the critical detail. GPUs handle the massive parallel processing, but agentic AI requires constant, complex logic orchestration before the data even reaches the GPU.
Correct. That requires a massive deployment of CPUs. When you scale a 4-to-1 architecture up to the enterprise level, you are talking about building data centers that consume the power of small cities.
The capital expenditure required to secure the chips, the copper, the cooling systems, and the real estate is staggering.
Which makes the market's reaction to this stellar earnings print highly revealing. Despite the massive beat and the raised guidance, the stock reaction remains relatively muted.
Proprietary modeling indicates that this specific mega-cap equity has historically faded on 4 of its last 5 post-earnings days.
It seems like institutional players are utilizing the liquidity event of earnings day to quietly exit their positions rather than add to them.
They are. The market has reached a point where it demands not just an earnings beat, but a structural re-rating of future global growth to justify adding duration at these multiples.
Institutional research indicates that active managers are highly aware of the capital constraints looming on the horizon for these tech companies.
On that point, let me push back on the inflation narrative that is driving those constraints, though.
Go ahead.
If we look back at our second theme, the energy shock easing via the Strait of Hormuz, we saw crude drop 4%. If oil is getting cheaper and supply is coming back online, doesn't that fundamentally resolve the inflation pressure that is driving the 30-year Treasury yield over 5%?
Or are internal models indicating that the market is conflating temporary geopolitical relief with structural embedded inflation?
Exactly.
Our proprietary updates strongly suggest the market is conflating the two. The drop in oil provides immediate cyclical disinflation at the headline level.
However, the structural drivers of inflation remain firmly entrenched.
Indeed, we are looking at sticky services inflation, the macro trend of deglobalization, and precisely the massive AI capital expenditure we just outlined.
So the 30-year yield breaking 5% is not reacting to front-month crude contracts.
Correct. It is reacting to the expectation of sustained fiscal dominance and long-term capital competition. The bond market realizes that rebuilding the global energy grid to support agentic AI is going to be highly inflationary.
Understood. Let's look at how this structural tension is manifesting in the volatility and credit markets, because this is where the surface narrative really breaks down.
Right. If you glance at the headline volatility metrics, everything appears benign.
The headline VIX declined to 17.44. To a casual observer, that suggests a calm market environment.
But our underlying flow data tells a very different story. The surface is calm, but the undercurrents are violent.
We tracked massive tail risk hedging occurring beneath that 17.44 level.
Specifically, major desks executed the purchase of 300,000 VIX May 27 call spreads across the 3142.5 and 245 strikes.
This specific position costs $3.2 million in premium, but it offers a potential payout of $350 million if the VIX spikes above 45.
That is a highly asymmetrical, low probability, extreme impact hedge.
Let's do a mechanical breakdown here, because this is vital for understanding market fragility. Remind us why dealer hedging at those specific upper strikes, the 31 and 32 levels, actually matters for the broader market delta. How does someone buying deep out of the money volatility insurance mechanically create a setup for a worse market crash?
Think of it through the lens of the market makers. When a major institutional player buys a massive block of out-of-the-money VIX calls, the dealers taking the other side of that trade are left with what we call a short gamma exposure.
They have sold the insurance.
Correct. So they carry the risk if the market crashes and volatility spikes. To protect themselves, dealers must dynamically hedge their books as the underlying indices move.
They can't just sit on the risk. They have to actively trade against it.
Precisely. If spot volatility begins to rise and the VIX moves toward those upper strikes, say hitting the 31 or 32 level, dealers are mechanically forced to buy VIX futures to cover their short gamma positions.
And this aggressive mechanical dealer buying exacerbates the upward pressure on volatility.
Indeed. Consequently, as the VIX spikes further, quantitative and systematic funds are forced by their own risk models to mechanically sell equities to reduce their value at risk.
The dealer hedging essentially acts as an accelerant.
It does. It can turn a standard 3% market correction into a violent, self-fulfilling sell-off.
Moving to the desk data for institutional credit flows, we see clear evidence that corporate treasurers are front-running this exact kind of stress.
We are tracking a 10-year high in the spread ratio between AA and BAA rated investment-grade credit.
The ratio is currently sitting around 0.56. We need to connect the dots here. How is the AI infrastructure theme directly causing a dislocation in the investment-grade credit spectrum?
It comes down to supply absorption. Approximately 93% of AI-related corporate debt issuance is currently falling into the AA rating category.
The mega-cap technology firms building these agentic AI data centers are highly rated.
Right, and they are issuing debt at a historic clip to fund their capital expenditures. This massive wave of supply is flooding the market,
which temporarily cheapens AA credit relative to BAA.
Correct. Investors are eagerly absorbing the high-quality paper funding the tech build-out, but it is deeply distorting historical spread relationships across the rest of the credit curve.
And we are seeing this defensive posture bleed down into the leveraged loan market as well. Internal updates show that collateralized loan obligation managers, or CLOs, are aggressively de-risking their portfolios.
To give some context, a CLO is essentially a vehicle that bundles together different tiers of corporate loans and sells them in tranches based on risk.
Right now, CLO managers are systematically dumping their exposure to CCC loans.
In that specific bottom-tier tranche, spreads have exploded by 117 basis points over just 3 months, reaching 705 basis points.
Managers are retreating upward toward the relatively higher quality B2 tranches.
That specific CLO migration is a classic textbook late-cycle indicator.
When institutional managers willingly sacrifice the higher yield of a triple C tranche to hide in a B2 tranche, they are signaling a profound lack of confidence in the fundamental health of the lowest-tier corporate borrowers.
Indeed. They are bracing for an outright default cycle in the weaker segments of the economy, even while the headline equity indices price in continuous economic expansion.
On that point, let us pivot to portfolio strategy and where the ultimate vulnerabilities lie. This week's data deck outlines a necessary structural rotation.
For the last decade, portfolio returns have been dominated by capital-light software and consumer technology companies.
But our models suggest a macro regime shift toward what we categorize as halo companies. Heavy asset, but low obsolescence.
The logic there is entirely driven by the physical constraints of the technology narrative we have been discussing. The agentic AI build-out, combined with necessary grid modernization and sovereign defense spending, requires immense physical infrastructure.
You cannot run a 4-to-1 CPU to GPU data center without copper, cooling systems, and massive baseline power generation.
This necessitates a structural portfolio pivot toward asset-heavy sectors like industrials, utilities, and energy infrastructure.
These halo companies offer low obsolescence risk and are perfectly positioned to capture the massive capital deployment that will characterize the next decade.
There is, however, a glaring contradiction in the current market flows regarding that thesis.
Right. While our internal models strongly favor these capital-intensive sectors due to the obvious physical infrastructure needs, proprietary flow data shows that hedge funds have actually been net sellers of U.S. industrials for 4 consecutive months.
If halo companies are the necessary foundation for the AI revolution, why is smart money dumping them?
That divergence highlights the dangerous gap between short-term momentum and long-term fundamentals.
Active managers are trimming their industrial exposure primarily to fund their highly concentrated momentum positions in a handful of mega-cap tech names, or to build cash reserves to manage margin requirements.
They are trading the immediate liquidity profile of the market rather than positioning for the underlying structural demand.
It is a performance-chasing mechanism, not a fundamental allocation.
Which brings us directly to the core vulnerability outlined in the desk data, the positioning of commodity trading advisors, or CTAs, and risk parity funds.
Gross leverage across these systemic strategies is currently at a fresh 5-year high. They are borrowing massive amounts of capital.
Yet their net leverage remains entirely flat, sitting at the 58th percentile on a 3-year look-back.
That specific metric is the key to understanding our third theme, the hedging disconnect.
Funds are utilizing historical amounts of borrowed capital to maximize returns, but they are neutralizing their directional market exposure by aggressively shorting macro indices and ETFs.
This is not a market characterized by high conviction bullishness.
No, it is a market characterized by extreme gross positioning that is only mathematically viable because of heavy beta hedging.
If the correlation between their long momentum books and their short index books breaks down, the forced unwind will be severe.
And that leads us to the ultimate tail risk scenario evaluated in our latest run.
The trigger for that unwind lies in the interest rate derivatives market.
We are closely monitoring the USD swaption volatility surface, which shows a significant increase of positive 0.62 basis points per day in the 1-month expiry, 1-year tenor.
For the listener, think of the swaption market as earthquake insurance for interest rates.
Right. When the price of a 1-month expiry swaption spikes, it means institutional players are suddenly terrified of a tectonic shift happening in the immediate future.
The swaption market is the most sophisticated pricing mechanism for interest rate volatility. That steep increase in the front-end volatility surface tells us the fixed income market is aggressively pricing in a sudden policy error or a hawkish shift.
The specific tail risk here is that sticky services inflation forces the Federal Reserve into what they term policy firming,
which means an outright rate hike, rather than the extended pause the equity market has fully priced in.
If that policy firming materializes, the mechanics of the resulting unwind would drain liquidity from the system instantly.
You would have the crowding out effect of massive sovereign debt issuance, compounded by the corporate debt required to fund these AI capital expenditures, all competing for capital at a higher interest rate.
That liquidity drain would force a violent, simultaneous unwind of the highly concentrated momentum trades currently supporting the S&P 500.
The equity market is currently operating on the absolute assumption that the discount rate has peaked.
If the underlying inflation data forces the bond market to price in a higher terminal rate, that 2.2% equity risk premium we discussed earlier offers zero margin of safety.
The complex divergence we have tracked today, the equity melt-up versus tightening financial conditions, would resolve aggressively.
And it would resolve in favor of the bond market's pessimistic outlook. We began this deep dive by outlining a market defined by deep structural contradictions.
The data confirms that while the surface indices appear pristine, the underlying mechanics, from investment-grade credit dislocations to extreme dealer gamma positioning, are exceptionally fragile.
Before we sign off, consider this final thought as you evaluate your own asset allocation. If this AI infrastructure build-out requires the sheer amount of physical capital, energy, and debt that our models suggest, the biggest winners of the next decade might not be the software developers writing the code.
It might be the companies laying the copper wire, pouring the concrete, and generating the electricity.
You have to look past the immediate equity momentum and respect the signals emanating from the credit and volatility surfaces.
Indeed.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color and cross-asset analysis.